Welcome back to the deep dive. Today, we're zeroing in, really focusing just on the numbers, specifically the financial picture the CFO laid out in the recent earnings call. We're going to skip the broader product vision stuff for now and really dig into the financial reality, the concrete results and what they're expecting for the next fiscal year.
That's the plan.
Yeah.
We want to get past just the headline figures and understand the context. What's the momentum? How stable is the foundation that led to that strong finish for fiscal year 2025? We really need to pull out the key business drivers and, maybe most importantly, unpack the assumptions behind their financial guidance for 2026.
Right, because it sounds like that guidance is built on a pretty specific view of the world, holding steady.
It really is. The core assumption, as we'll get into, is that the current macro environment doesn't really change much. That consumer resilience they saw continues. It's a big if.
Okay, so let's start with the scorecard. Fiscal year 2025, Q4 in particular. How did they close things out?
They finished strong, definitely beat expectations. For the fourth quarter, net revenue jumped 12% year over year. That's 11% in constant dollars, which was better than they had guided.
And that flowed through to the bottom line?
It did. EPS, earnings per share, was up 10% year over year. Same story there. Nominal and constant dollars, also ahead of what people were expecting.
Interesting, but you mentioned the core drivers, things like payment volume, transactions. They weren't necessarily accelerating dramatically in Q4 compared to Q3.
Exactly. That's what's kind of fascinating here. The operational metrics themselves were pretty stable. If you look at constant dollars for Q4, global payments volume up 9% year over year. That's just a slight tick up from Q3. Total processed transactions grew 10%, again, relatively stable. And cross-border volume, if you exclude intra-Europe, that was up 11%, also pretty much in line with Q3.
Okay, so if the core engine speeds, the volumes and transactions were steady, but the revenue came in higher than expected, what explains that gap? Where'd the extra juice come from?
Yeah, it points towards things other than just raw volume. The CFO basically put it down to a few things. Primarily, better than expected performance from their value-added services VAS and also from their commercial and money movement solutions. Throw in a little bit of help from foreign exchange rates and, well, that's how you get the revenue beat.
So it's those strategic areas, the VAS and commercial stuff, really starting to punch above their weight compared to just processing payments.
That's the takeaway. It shows those investments are delivering maybe even a bit faster than the core volume growth itself.
Let's dig into those volumes a bit more, though, because that gives us a feel for consumer health. How did things look internationally first?
Sure. So internationally, total payments volume was up a solid 10% year over year in constant dollars. The main thing to note there was actually an acceleration in Asia Pacific. It sped up by about 2.5 points.
Oh, interesting. Why was that?
The CFO said it was mostly down to some timing effects, nothing too dramatic, but also a modest but noticeable pickup in activity coming out of mainland China.
Okay. And then the big one, the U.S. How's the consumer holding up there?
Still looking pretty resilient. U.S. payments volume grew 8% year over year. That was slightly better than Q3. And what's quite telling is that both credit and debit grew at that same 8% pace.
Equal growth in credit and debit. What does that signal to you?
It suggests pretty broad-based spending strength. It's not like people are suddenly leaning heavily on credit, nor are they pulling back drastically on debit. It looks, well, resilient. But, and this is a really crucial point for you listening, while the overall picture is stable, there's a nuance in who is spending. E-commerce, no surprise, grew faster than face-to-face. But the key thing the CFO highlighted was that growth across the different consumer spending bands stayed consistent. And critically, the highest spend band kept growing the fastest.
Okay. So the overall average looks resilient, but it's being led, or at least strongly supported, by the higher income consumers still spending quite freely.
Precisely. And that's really important because those higher spending customers often drive more profitable transactions. That observation really underpins their confidence, I think, in projecting continued resilience into 2026.
Makes sense. What about cross-border, excluding intra-Europe, as usual?
Still strong. Total cross-border volume up 11% year over year, constant dollars, again pretty stable compared to Q3. E-commerce continues to be a powerhouse there. It grew 13%.
Wow, 13%.
Yeah, and it now makes up about 40% of their total cross-border volume. Just think about that. It's become a huge, reliable engine.
And travel, is that post-COVID recovery still going strong, or is it starting to level off?
It actually improved a bit sequentially. Travel volume growth hit 10% in Q4. Now, that's still growing faster than pre-COVID levels, so the normalization, if you want to call it that, is happening at a pretty elevated level. The CFO mentioned it got a bit of a boost from more commercial travel volume and also some holiday timing effects in places like CEMEA for outbound travel.
Okay, this brings us nicely to what you called the yield story. How revenue growth can sometimes run ahead of the volume growth that supposedly drives it. You saw that in Q4.
Definitely. It's a sign they're either getting better prices or selling a richer mix of services, or both. Take service revenue, it grew 10%. That clearly outpaced the 8% growth in payments volume, which it's mainly linked to.
And why the difference?
Primarily card benefits, managing those effectively, and some targeted pricing adjustments they made.
And I think data processing revenue was an even starker example.
Absolutely. Data processing revenue was up a massive 17%, way faster than the 10% growth in actual processed transactions. There wasn't just volume doing the work. The CFO pointed mainly to pricing actions they rolled out in the second half of 2025. And crucially, a higher mix of cross-border transactions, which typically carry higher fees.
So pricing power and favorable mix changes.
Exactly. And even other revenue was up 21%. Again, driven by things like consulting, advisory services, think fraud tools, data analytics for clients, and yes, more pricing initiatives.
So the core processing might be stable, but they're successfully layering on higher value services and exercising pricing power.
That's the picture. And it leads right into how those specific growth engines performed. These are the areas they've been betting on strategically.
Let's start with value-added services, VAS. How did that do?
VAS really kind of stole the show in Q4. Revenue there grew 25% year over year in constant dollars, hit $3 billion for the quarter. That was another number that came in better than expected.
25% growth. What's fueling that?
Mainly, they're issuing solutions, helping banks issue cards and those advisory services we just mentioned. Seems like clients are really buying into those offerings.
Okay, and the other big strategic push, commercial and money movement solutions, or CMS.
CMS revenue was up 14% year over year, also very strong. And maybe more significantly, the volume of commercial payments grew 10%.
Faster than overall payment volume growth, right?
Right, 3 points faster. Which tells you that the commercial side of the business is growing its share of the overall pie. They put that down to winning new clients and good performance in cross-border B2B payments.
And Visa Direct. That real-time payment network seems critical.
Still growing like crazy. Visa Direct transactions were up 23% year over year. That amounted to 3.4 billion transactions just in Q4. Shows that push into faster payments, both domestic and cross-border, is really scaling up.
Before we look ahead to 2026, just quickly on the Q4 costs. Operating expenses were up 13%, a bit higher than planned.
Yeah, slightly above their own expectations. The CFO flagged two main reasons. One was foreign exchange rates having a bigger negative impact than forecast. The other was higher personnel costs due to deferred compensation mark-to-market adjustment.
Mark-to-market sounds complicated.
It's basically an accounting adjustment, non-cash mostly, reflecting changes in the value of investments linked to compensation plans. The key thing is, the CFO said it was EPS neutral because they also had higher than expected non-operating income, mostly from their own investment returns, which offset it.
Got it. So a bit of noise on the expense line, but it balanced out. Okay, let's pivot. Fiscal 2025 overall. 11% net revenue growth for the full year, 14% EPS growth. Solid year. Now, the outlook for fiscal year 2026. This all comes down to those macro assumptions, doesn't it?
Absolutely. That's the foundation for the whole forecast. The CFO was very explicit. They said, look, we're not making some bold new economic prediction here. Our guidance assumes that the macro environment basically stays where it is right now.
Meaning consumer spending stays resilient like it was in Q4.
Exactly. It assumes that the growth levels they saw exiting fiscal 25 don't materially deteriorate. No major slowdown baked in.
Given all the uncertainty out there, inflation, geopolitics, rates still high, isn't assuming stability kind of, well, optimistic? Did they talk about what happens if things do worsen?
That's the risk, isn't it? They didn't really offer a downside scenario guidance. It's presented more as, here's what we expect if current conditions hold. It's based on the momentum they have right now, rather than forecasting a big change either way. So with that big assumption in place, the guidance itself, on an adjusted basis, is pretty straightforward and consistent.
Okay, what are the numbers?
Low double digits.
Okay.
For everything.
Yeah.
Net revenue growth expected in the low double digits. Adjusted operating expense growth also expected in the low double digits. And they specifically say that's consistent with or matching the net revenue growth and adjusted EPS growth. Again, expected in the low double digits.
Matching OPEX growth to revenue growth. That signals they plan to keep investing heavily, right? Especially in those strategic areas like VAS and CMS that are driving the outperformance.
That's clearly the message. They're funding the growth, but that spending won't be spread evenly through the year.
Ah, right. Big events coming up.
Exactly. OpEx growth will spike in Q2 and Q3. Q2 has the big marketing spend around the Olympic and Paralympic Games. Then Q3, and spilling into Q4 a bit, you've got the FIFA World Cup costs hitting the books. So expect the year-over-year OpEx growth comparisons to look biggest in those middle quarters.
Okay, that makes sense. We should also flag the tax rate. Looks like that's expected to tick up a bit.
Yeah, just slightly. They're guiding to an adjusted tax rate between 18.5% and 19% for fiscal 26. That's up a bit from what they actually saw in 24 and 25, which is sometimes under 18%.
Why the increase? Policy changes.
No, nothing like that. It's simpler. It's basically just the absence of some one-time tax benefits they were able to realize in the past couple of years. So it's more like the rate normalizing back towards their longer-term average target.
Okay. And finally, did they give any indication of how fiscal 26 is actually starting? Any early data from Q1?
They did. They gave numbers through October 21st, so the first few weeks of their Q1. And the momentum seems to be holding. U.S. payments volume up 7%, total cross-border volume up 12%.
Still strong then. Any details within cross-border?
Yep. E-commerce was actually up 14%, so maybe even a slight acceleration there. Travel, also strong at 11%. Based on that strong start, they expect Q1 adjusted net revenue growth to be at the high end of a low double-digit range.
So the year is starting off consistent with the overall guidance, maybe even a touch stronger.
Seems that way. It lends some credibility to that stability assumption, at least for now.
Okay, so summing it up, a picture of stable core operations, but real strength coming from pricing power and those strategic growth areas like commercial and VAS. And the plan for 2026 is basically more of the same low double-digit growth across the board, fueled by continued investment, all resting on that crucial assumption that the macro environment doesn't throw them a curveball.
That's a good summary. Quality growth, strategic investment, and yes, a significant reliance on continued consumer resilience and overall economic stability. They're investing at the rate they're growing to keep that competitive edge.
Right. Which brings us to a final thought, something for you, the listener, to chew on as you process all this. The CFO made a specific point. For the first time in 3 years, they're actually projecting a non-operating expense for 2026. Somewhere between, $125 million and $175 million. That's a shift from the non-operating income they've booked recently from their investments.
A noticeable shift.
So the question is, even though their core business outlook is robust and assumes stability, what might this specific shift from investment income to investment expense tell us? What could it signal about their own internal view on maybe market liquidity, or where short-term interest rates are headed, or just general investment returns in the year ahead?
That's a fascinating point. It does suggest maybe a subtle financial headwind they're anticipating, separate from the core operations.
Yeah.
Something to definitely think about. Well, thanks for digging into those numbers with us today.